What's going on, investors? Welcome back to Fallible with me, AK. I'm so glad you're here hanging out with us. And today we're going to talk about why bad news and bad things for the economy are actually good for the bull market. And it's part of why this bull market has been going on for so long. I say that like I'm complaining. I'm not complaining. This is great. My stocks are doing great. But it all has to do with this concept that I'm going to explain to you, which is called the risk cycle. And to help me describe this risk cycle, I've called upon the smartest, most good-looking guy I know, Alex Barrow from Macro Ops. And in his latest macro intelligence report, which is a premium report that he only sends out to premium Macro Ops members, he talks about this concept a little bit, the concept of the risk cycle. So he says the risk cycle is a way of thinking about the broader psychology of participants in the market. Think of it as the collective mood and subsequent actions of investors and business people in the market and larger economy. So all he's saying is that the risk cycle is a way that we kind of measure and keep track of what the collective mood in the market is. Are people feeling good? Because if they're feeling good, they're going to take on more risk. Or are people afraid? Are they scared? Are they unsure and uncertain? Because if that's the case, then they're not going to take that much risk. And the way this works is that it goes in a cycle up and down. There'll be periods of time where people are feeling real good and they take on more risk, and there'll be periods of time where they're not feeling so good and they're going to take on less risk. Everything is cycles. And markets are pretty cool because you could just see them in action. You could literally see prices represent psychology. It's amazing. But you knew that, that's why you're here. So Alex explains that there's a feedback loop between the mood of all of us and then how the market and economy acts. And really it's a reflexive feedback loop. So one affects the other and that in return affects the one again. I don't know if that made sense. But here, when the market or economy performs well for an extended period of time, the collective mood improves and it becomes more and more optimistic. And then this optimism, which is driven by people thinking that what just happened is going to continue happening because, you know, it's been a good party so far, the party's going to continue. That leads to more risk taking in the financial and real economy. So like I said, you're feeling good, you're going to take more risk. If you are winning on a position, what do you want to do? You want to add more money into that position, right? At least that's how you feel. And most investors, let's be honest, they're acting on emotions. I know you're not. I mean, you're fallible, but most are. If they're on a streak, they want to keep that streak going, add more. So it's just like when you're taking on more margin to buy stocks or borrowing more money to fund a business. You want to shovel that coal into the fire. So like I said, it's reflexive. So the market and economy doing well makes people optimistic so that they leverage up and throw more money back into the economy. So guess what the economy does at that point? It does even better with all that new money coming in. So the collective action boosts the market and the real economy, which feeds directly back into the collective psychology again, and on and on and on. Because if the market is doing well, then what happens? Oh, people get even more optimistic and they pour more money in, so it gets better and better, and it keeps going like this until you're out of focus and you're not in the camera anymore. The feedback loop eventually leads to investors, consumers, business people getting over their skis. So when he says over their skis, he means that people are getting over leveraged. They get too optimistic and just go completely on emotion and keep throwing money they shouldn't be throwing into the market and businesses. People and businesses over invest in non-productive assets. So at the beginning of this cycle, it's much easier to find productive assets to invest in. Just like say 2009, everything was a deal. Whatever you put your money in, it went up because you're at the bottom, right? But now try looking for a good value. And by value, I mean, you know, the classical definition of value, because everything looks overvalued. Finding a good deal is much tougher. And it's the same in business. Every extra dollar you put in is not as productive as that last dollar. It's diminishing returns. And Alex says that's exactly what happened in the tech bubble and the housing bubble with the use of debt. Remember ninja loans? No interest, no job, no problem. Here's a huge house you can't pay off. So the collective euphoria, because that's what it turns into, it transforms from optimism into euphoria. That drives an abundance of risk taking using leverage that eventually has to be unwound because it can't go on forever, right? There's eventually a tipping point. So when that tipping point is reached, the unwind causes forced selling. The leverage creates instability because it spawns forced sellers, and that prompts panic, hysteria, and a full reversal of the risk cycle. So there's a normal rate of selling, right? But when there's leverage in the mix, that rate of selling is just extreme. And that's what Alex is saying, it's unstable because it wasn't natural to be leveraged up that high, and now it's not going to be natural when you're trying to de-lever all that. And when you're going through that de-leveraging, that's when the risk cycle finally moves. People aren't optimistic. It goes the other way around now. Economy starts doing worse, so people invest less money, which makes the economy do even worse, which people are more pessimistic, and then, you know, you keep going until you finally hit a bottom again, where the pessimism is just bottomed out, which is again what I was talking about in 2009. fine, right? The really smart guys were investing back then, you know, grabbing up those deals, but most of the people, they were too scared to. They were too scarred by what just happened. They're super pessimistic. See, the risk cycle is at the heart of the market cycle. It's what causes blow off cyclical tops and leads to painful extended bear markets. And if you think about the risk cycle we just discussed, it has everything to do with sentiment. And that's why we review sentiment in every market review video, because it's really important. I mean, the markets, they move based off psychology. So you got to track things like this. So Alex explains that the current bull market has endured for so long, and it's likely to go even longer because of where we are in the risk cycle right now. We are not at the top. We are not where people are super euphoric, you know? The sentiment isn't at those levels. We've had repeated shocks and mini rolling bear markets, which might not sound good, but actually they're great. They are what's keeping this bull market alive, because those are the things that keep the collective mood from reaching that euphoric state. We've got a high political and economic uncertainty. People are still reeling from the financial crisis in 2008, and just the crazy price action in the market, it's kept everyone from leveraging up because no one's that optimistic. And Alex says, yeah, there's been isolated examples of euphoria like the crypto bubble and some signs of mania in the private equity and venture capital space, but those mostly ran their course and they never posed systemic risks to the rest of the economy. See, to cause a bear market, or I mean to first cause the euphoria that eventually leads to a bear market, it needs to affect the entire market. So it can't just be isolated to crypto or VC and PE investments, which most people aren't involved with. We need it in the general market where everyone's retirement is. Or you need it in something like housing, like we had in 2008, which is just completely systemic to the economy. Because if housing goes, the economy goes, right? And the market goes. So it's different. See, all these little bubbles that we see, they're not going to be the big thing that brings down the market. Those things are isolated because they're not systemic. So that means that everything negative and chaotic that's kept the collective a little bit worried and a little bit concerned, that's actually been bullish for this market cycle. And it's likely to continue to be so. The time that we should be worried about the market turning is when we notice that nobody else is worried about it. As soon as everybody is a bull, that's when the bull will be over. Hopefully this risk cycle gives you a little more insight into why we're always tracking sentiment. It's like I always say, a bull market dies on euphoria and not pessimism. And we have not hit that euphoria yet. And you know, maybe we wouldn't have euphoria if everybody just downloaded my FOMO trading guide, because then they would know the best tips and tricks to keep their emotions in check. You know what? Actually, you should download this guide so you're not one of those euphoric people. Do you like this segue? I mean, did you think I wasn't going to promote this guide? It wouldn't be a real fallible video if I didn't. So if you haven't already, go download this guide. I'll put a link in this video and a link down below. Throw in your email, it's free, I'll send it your way. It's good, I promise. And if you like this video and want to see more videos like this, then subscribe to this channel and hit that notification bell so you get an email notification when our future videos come out. Publishing every single day. Come hang out with us. We have so much fun. I'm having fun. Come back to see what I do with this tropical passion fruit soap. So subscribe and I will see you in the next video. In the meantime, stay fallible out there. Bye bye.